Welcome back to Forex Focus, brought to you by IG. Today we're checking in on inflation ahead of Wednesday's April CPI report, asking the question that we've all been asking for months now: will inflation lower towards the Fed's 2% goal? We're going to see where we're at, what's expected, and possible implications for interest rates and the US dollar. Let's get into it. Headline inflation yet to crack 3%. Taking a look at this graph, it's been a remarkable run here in the fight against inflation. CPI ripping all the way up to 9% there in 2022. A lot of efforts from the Fed, including hiking interest rates all the way up to above 5%. And those effects have played out, cutting that down all the way below 4%. But a very interesting trend here over the past almost year is stuck in this 3% handle. The Fed desperately wanting to get these measures down to 2%, what they think is a sustainable level going forward. But you take a look, and last June's reading of 3% even is the lowest that we've gotten since then. This month, giving us April's data, is expected to be 0.1% lower, the right direction, at 3.4%, but not near the lowest we've seen, and starting to worry the Fed and other officials just what it might take to get this inflation towards those sustainable goals. But there is a more reassuring metric here, tracking core inflation, which takes out some of the volatile assets in this basket of goods, like food and energy. We've seen a more consistent trend, albeit higher numbers, with 3.8% last month being the lowest that we've seen in this particular run of inflation. We are expected to see a drop of 0.2% here towards to 3.6%. Still not close to 2%, but I think a 0.2% drop as expected would inspire some confidence that perhaps the headline inflation number hasn't really been giving people over recent months. But then again, this could go either direction. We could see an uptick very easily towards that 4%, or a drop greater than to 3.6%. We'll see. But what are the implications of this number? Interest rates, it's been an interesting story. And keep in mind that CPI, although definitely is the more publicized inflation measure over the recent years, it's not actually the Fed's preferred inflation gauge. They prefer tracking the PCE inflation, which is just a different basket of goods, but they believe more accurately tracks the U.S.'s overall basket of goods, and is a better indicator of how their monetary policies are playing out in the U.S. economy. But all being said, these are both measures of baskets of goods and prices in the U.S., so we should see comparable figures. If we were to see a mishit on these headline and core inflation readings in either direction, we could see possible implications for when interest rate cuts will come from the Fed and trickle down through the economy. Here we're taking a look at the CME's Fed Watch tool projections for the September Fed meeting, which now currently is the likely date for the first 25 basis point cut from the Fed, the most likely outcome being a 25 basis point cut at 49%, but also an outsized chance of greater than 25% or 25 basis points of cuts, and an unlikely 36% chance that we stay where we are. So a mishit on this inflation reading could shift these odds. They could push possible first cut all the way back out to November, or if inflation lowers very heavily at this reading and is supported by other metrics in the coming weeks, maybe we could see a rate cut pushed up to the July meeting. This has been a very interesting story so far this year, as rate cuts just keep getting pushed out. Right now, still looking at 1 to 2 cuts by year's end. But we'll see that this CPI measure especially has not given investors and officials confidence that we are where we need to be in terms of inflation to begin cutting rates. But we are starting to see from the April labor market data with non-farm payrolls, we are beginning to see the employment sector start to cool off. Maybe that translates here as well in April's inflation numbers. But it'll be interesting to see where we end up for April and how the PCE data in the coming weeks supports or contradicts the CPI measures. And lastly, wanted to touch on how this might affect US dollar prices. All else equal, higher inflation at this stage of where the current landscape is, equating to higher interest rates in the US, would mean higher demand for US dollar against some of these other currencies, especially taking a look at that dollar-yen pair already through historic highs. I note that one in particular because of the interest rate differential between the two countries. Japan at near 0% interest rates and the US at above 5% interest rates. If that were to play out, if that dynamic plays out longer because of interest rate cuts getting pushed back, we could see this US dollar strengthen. But the inverse is also true. If inflation lowers, we start to get those cuts quicker than expected, then we could see the dollar depreciate against a lot of these major currencies. An interesting story against these European currencies, especially, is their central banks are looking towards summer cuts. The Bank of England 50-50 on a June cut, and the European Central Bank in a similar situation. If they were to get pushed out, per se, and we introduce a July interest rate cut, then we would be on more of a level playing field in terms of interest rates, and we could see that play out in a lot of these exchange rates in the forex market. A lot to stay tuned into surrounding this Wednesday reading. We'll see how this CPI number comes in, how it affects future rate cuts, and what it could mean for US dollar prices. Stay tuned, and thanks for watching.